Hey everyone, let's talk about how to really cut through all the noise in Forex trading. Today, we're going to break down a very systematic, rule-based method known as the double gap strategy. Seriously, it's designed to give you a clear edge by completely changing how you look at the market. You ready for this? Let's dive in. So let's start with a question that I think every Forex trader struggles with at some point. How on earth are you supposed to keep up? I mean, with all the majors and minors, you're just facing this constant flood of charts and data. It feels like you have to be looking everywhere all at once just to find one single decent trade. 28. Yep, if you want to track the 8 major currencies, that's how many charts you're told you need to be watching. I mean, come on. Trying to make sense of all of that at the same time, it's the perfect recipe for analysis paralysis. It is just completely overwhelming. And you know, this gets to the real heart of the problem. A Euro USD chart might be trending up, but that only tells you what's happening. It doesn't tell you why. Is the euro surging while the dollar is just sitting there flat? Or maybe the dollar is plummeting while the euro is just holding steady? If you don't know the answer, you are trading with a massive blind spot. So, here's the big idea, and trust me, it's a fundamental shift in perspective. We are going to stop getting lost in those 28 par charts and start focusing on the 8 major currencies individually. Think of it like this. The old way is kind of like watching a tug of war where you can only see the rope moving back and forth. You only see the result. This new way, it lets you see the individual strength of each person pulling on that rope. You can stop guessing and start analyzing the actual root cause of the movement. And this all boils down to a really simple but powerful principle: currency strength. It's a foundational idea in any market, right? You buy what's strong and you sell what's weak. This strategy is all about applying that core logic directly to Forex. I love this because it perfectly illustrates the idea of market equilibrium. The Forex market is basically a closed system. Money doesn't just appear out of thin air or vanish. So if one currency is being bought up like crazy, that capital has to come from somewhere, which means another currency must be getting sold off. Your job as a trader is to find that flow of money. So the huge takeaway here is this. By shifting your focus from pairs to individual currencies, you can distill all the information from those 28 charts into one single, powerful view. That's the edge we're talking about, replacing total information overload with real clarity and focus. Okay, so we've covered the why, this whole idea of trading strength against weakness. But how do we actually spot these opportunities in real time? Well, this brings us to the core signal of the entire strategy, something called the double gap. The double gap, or D-gap for short, is the key signal we're on the hunt for. Now, it might sound a little technical, but the idea behind it is incredibly simple. It's that exact moment when the strength of the two currencies in a pair clearly start to diverge. One is getting stronger, while the other's getting weaker. Here's how you actually find it. The system calculates a strength value for each currency based on how it's doing against all the other majors. Then, we look at the change in that strength value over the last 2 periods, or bars. When one currency's strength is shooting up while its partner's is dropping fast, that powerful divergence, right there, is your double gap signal. Let's make this super concrete. Imagine you see the strength line for the euro just dropping off a cliff. At the exact same time, the strength line for the New Zealand dollar is climbing strong. What does that mean? The euro is weak, the Kiwi is strong. That is a classic double gap, and it gives you a high probability sell signal for the EUR and ZD pair. It's as simple as that. Now, this is a really, really critical distinction to make. The D-gap is so powerful because it identifies a true strong versus weak setup. This is way more reliable than what's called a single gap, which is often just a weak versus even weaker scenario. You know those trades? They lack real conviction, they're prone to reversing on you. The D-gap filters for genuine, powerful momentum. Okay, so spotting this signal is one thing, but a real strategy needs a solid framework for how you actually execute and manage your risk. So let's go over the rules that really tie this whole thing together. These 5 rules are basically the foundation of everything. The first 2 are all about picking your battles. Always trade with the higher time frame trend and just stay on the sidelines if the market is going nowhere. The last 3, that's the core of your risk management. Always use a stop loss. Be quick to cut your losses, but be patient with your winners. And most importantly, never risk more than 1% of your account on any single trade, period. And you know, this is what it all adds up to. The double gap isn't just some clever entry signal you find online. When you combine it with the principles of currency strength and a strict set of rules, it becomes a complete methodology. It's a systematic way to analyze, enter, and manage your trades in the Forex market. And we'll end on this thought right here. A system like this gives you a clear, logical framework. It gives you the rules. But what it can't give you is discipline. The system can't click the mouse for you. The ability to follow those rules day in and day out, especially when things get tough, that has to come from you. And that's the real secret to making any strategy work in the long run.
Thank you for watching this video. See the download link below in the description. If you like our hard work, please give us a like and subscribe for more trading tools and updates.